Hey everyone, welcome. So if you've ever felt totally overwhelmed by just the sheer volume of financial jargon out there, well, you are in exactly the right place. Look, every experienced investor was once a beginner, and today I'm going to act as your guide. Through this explainer, we're going to demystify the stock market together, breaking down all those big complexities so you can start confidently building your long-term wealth. Let's dive right in.
So here's our roadmap for this explainer today. We're going to cover the case for investing, break down stocks, funds, and ETFs, translate some essential market terminology, figure out how to evaluate your first stock, and finally, navigate stock market taxes.
All right, part one, the case for investing, or how to beat inflation over time. Because you really have to ask, why put your money at risk in the first place?
Well, the core problem we all face is inflation. It's just quietly eating away at our purchasing power every single day. I mean, think about it. 100 years ago, a median home cost just $3,200. 50 years ago, it was around 33 grand. Today, we are looking at a median price of roughly $400,000. The prices of assets tend to go up, right? And that's partly because the value of cash simply goes down. So to protect your future, you absolutely need an asset that outpaces this invisible thief.
And the solution? It really lies in historical returns. Over the past 30 years, the stock market has averaged a 9.9% return. Over 50 years, it's 10.8%, and over a full century, an average of 10.5% every single year. So yes, market crashes are absolutely a reality, but over time, the historical data proves that the market consistently recovers and pushes upwards.
Moving on to part two, stocks, funds, and ETFs, which are your vehicles for growth. Now, before choosing your vehicle, just remember that at its core, a stock is literally just a tiny unit of ownership in a real business. If you buy a share of Apple or Microsoft, you are, technically speaking, a part owner of that company. Once you actually own those units, you've got to decide your strategy. And there are four main types of investors out there. You've got your buy and hold investors. They basically set it and forget it for years or even decades. Then you have traders who buy and sell constantly. Speculators take massive risks on smaller companies, just hoping they skyrocket. And finally, dividend investors who passively collect a portion of the company's profits. Now, if you are a beginner, I highly encourage you to stick to those slow and steady buy and hold or dividend strategies. Day trading and speculating with large chunks of your hard-earned cash? Yeah, that's just a recipe for disaster when you're just starting out.
But here's the thing. You don't even have to pick individual stocks. You could just buy an index fund. Think of this as a massive basket of stocks. So if it tracks the S&P 500, for example, it buys shares in the 500 largest U.S. companies. You and a bunch of other investors pool your money together, the fund buys the shares, and bam, your investment perfectly mirrors the overall market. It is the ultimate hands-off passive strategy.
But then, back in 1993, a brand new vehicle hit the market, the ETF, or Exchange Traded Fund. You can basically think of an ETF as Index Fund 2.0. It's still a bundled collection of securities, but instead of pooling your money with a manager who only buys the stocks at the very end of the day, an ETF is completely pre-packaged. You trade that whole package directly with other investors throughout the day, exactly as if it were a single stock.
So the absolutely crucial point here is understanding how these two actually compare. While both are fantastic low-cost options, ETFs generally have much lower minimum investment requirements. Heck, sometimes you can literally buy a fraction of one share. ETFs also give you intraday liquidity, which just means you can buy or sell them while the market is open, whereas index funds, again, only process at the end of the day. And finally, because you're trading that ETF directly with another investor, they're actually structured to be more tax efficient than index funds, and that is going to save you money in the long run.
All right, part three, essential market terminology, or speaking the language. Let's go ahead and decode some of that financial jargon that intimidates so many newcomers from ever taking their first step.
You probably hear these two animals mentioned constantly on financial news. A bull market basically means stocks are generally trending upward. And why a bull? Well, think about it. A bull thrusts its horns in an upward motion. These periods are great, and they usually last an average of about 3 to 4 years. On the flip side, a bear market happens when the market drops at least 20% from its peak. It's called a bear market because a bear swipes its claws in a downward motion. Now, these are definitely painful, but they historically average a much shorter duration of around 9 months.
Next up is the sheer immense power of the Federal Reserve. When you see the term quantitative easing, or QE, that essentially means the Fed is printing money.
That extra cash flows straight into the economy and very often pushes stock prices up. Quantitative tightening is the exact opposite. They're pulling money out, which usually pushes stocks down. This really perfectly illustrates an old Wall Street adage: don't fight the Fed. Honestly, their monetary policy can sometimes impact the stock market way more than the actual health of the economy itself.
Okay, please memorize this next term, the dead cat bounce. When the market is crashing, it almost never goes straight down in a straight line. It bounces. And what happens is, a lot of amateur investors will see a stock drop, bounce back up slightly, and they immediately get FOMO, the fear of missing out. So they buy in, fully believing that it's the bottom. But just like Newton's third law of physics, even if a dead cat falls from a tree and hits the pavement, it's going to bounce on impact before settling. It is a false recovery, guys. Please, don't fall victim to it.
Moving right along to Part 4, evaluating your first stock and finding the winners. If you are actually feeling bold enough to try picking individual companies, how do you actually go about doing it?
It really breaks down into a simple two-step process. Step 1 is discovery. This is finding the stocks using free screener websites, checking out financial news outlets, or spotting trends. Step 2 is evaluation, and this is absolutely vital. Relying on a hot tip from your neighbor or some guy at work, that does not replace doing your own homework. You literally must do rigorous due diligence before putting your hard-earned money on the line.
When you're evaluating a stock, you'll encounter a few key metrics. Market cap tells you the total value of the company. The PE ratio tells you the price relative to their earnings, but I want you to focus specifically on volume. Volume shows exactly how many shares of that stock trade hands every single day. If you buy a stock with a volume close to 0, that is a massive red flag. Even if the price goes up, you could easily get financially trapped simply because there are no buyers on the other end to purchase your shares when you finally want to cash out. Always ensure the stock is highly liquid. And finally, Part 5, navigating stock market taxes and keeping your money. I know. It makes everyone anxious, but dealing with the IRS is actually highly manageable.
Let this one golden rule just calm your anxiety right now. You only trigger a tax consequence when you close your position. Think about it. If you buy Microsoft at $100 and it rockets up to $150 by the end of the year, but you just hold it, you owe absolutely nothing in taxes. Just watching a stock's value go up on a computer screen does not mean you owe the IRS a single dime. Not until you actually click that sell button.
Patience directly impacts your wallet. When you do sell for a profit, the amount of time you held that stock totally dictates your tax rate. If you hold a stock for 1 year or less, it's considered a short-term gain, and it's taxed at your regular higher income tax bracket. But if you wait and hold it for more than 1 year, it becomes a long-term gain. Because the government actually wants to encourage long-term investing, those tax rates plummet down to somewhere between 0 and 20%, depending on your income. Seriously, waiting just a year and a day? It's an absolute game changer for your wealth. But hey, let's be real for a second. Not every single stock goes up. So what actually happens when you inevitably lose money in the stock market? It hurts, for sure, but the IRS actually offers a really surprising silver lining here.
When life gives you lemons in the stock market, you can essentially make tax-deductible lemonade. It's a strategy called tax loss harvesting. If you close a position at a loss, those losses can cancel out your stock gains. But even if you just have pure losses for the entire year, the IRS allows you to deduct up to $3,000 of net stock losses against your regular, everyday taxable wage income every single year. It literally lowers your overall tax burden. And if you lost more than $3,000, that remaining loss just carries forward into future years until you've used it all up.
So do you see how all these puzzle pieces fit together? We've covered everything from inflation to the different vehicles like ETFs, market jargon, evaluating stocks, and even the tax implications. So I'll leave you with this final, somewhat provocative thought. You know the tools now. Are you going to be an active stock picker trying to beat the market? A passive indexer, just letting the market do the heavy lifting? Or maybe will you build a solid core foundation with an ETF and then satisfy that itch with a few smaller active stock picks on the side? Look, the stock market isn't some get-rich-quick scheme. It's a marathon. So make your choice, start small, and take that very first step toward building your financial future. Thank you so much for exploring this with me today.